Hi, it's Chris, and I came across an article in the Wall Street Journal recently, which I thought I'd share and just talk about a strategy you might be seeing and its pros and cons, and perhaps generally why I'm not into it. So let me show you what I'm reading here. It is these hot new funds. Let me just get my little highlighter because I love that stuff. These hot new funds are boomer candy for retirees. Derivative strategies and ETFs allow investors to chase stock returns while also protecting against a potential market downturn. Well, I think what's important to know right from the get-go, and I'll tell you because I've read through the article is, I think it covers these generally pretty well without touting them too much, if at all, while also protecting against a potential market downturn. Well, how much protection are you actually getting? And it allows investors to chase stock returns. I certainly think that's appropriate, chasing stock returns, because you're not going to get necessarily full stock returns in this. And I'd also, when you have protection from these products, anything other than an insured, a truly insured investment from an annuity company, I really am not a huge fan of. And I just want to share the pros and cons of this product as we go through the article together. So it goes on to read that baby boomers who aren't ready to walk away, let's see here, baby boomers, where's my pointer? I love my pointer. Baby boomers who aren't ready to walk away from the stock market are flocking to a hot new class of funds that seek to ease the pain of its swings. Even as signs of cooling inflation have powered major indices to new highs, investors have poured billions into exchange-traded funds that use derivatives to produce extra dividend income or protect against losses. So derivatives are things like options, futures, forward contracts, just these derivatives, really, things that aren't stocks and bonds, these other products that can be used to, as they say, provide extra dividend income or protect against losses. But the protection, I'll show you in a minute why I'm not. Don't be misled. So such funds were almost non-existent 4 years ago, give retirees and other investors the chance to chase stock returns while also protecting against a potential market slide. The funds have taken in massive monies to almost $120 billion in total. So the reason they were non-existent 4 years ago, well, they've existed in mutual fund format and potentially closed-end format, different than ETFs. All these semantics about the structure of these investments, whether it's a mutual fund, an ETF, or a closed-end fund. True, these ETF funds were not existent 4 years ago, but they existed in different iterations, again, whether an open-end fund or a closed-end fund. So the most popular of the strategies, according to the author, I haven't fact-checked which particular strategy has the most money in it, are dubbed equity premium income by fund managers, and they invest in large cap stocks while also selling options on those shares, almost like a covered call strategy. The funds generate higher dividend income that is typically in a stock fund, sometimes 8 to 10%. I won't disagree, but they also cap investor gains and carry chunky fees. Excuse me a moment here. So I will fully agree with cap investor gains. I really can't quantify chunky fees, so I have to ignore that on you. They talk about the price of these in a little bit, but the fact that they cap investor gains. So here you are I'll touch on it a little bit. Here you are, you're going to be in a fully stock-based portfolio with full stock risk except for the equity income premium, right? So you have stocks have full risk of loss from 100% of your money down to 0%. This is only offset by what they're calling here equity premium income. So if stocks decline over some period of time and you're earning 8 to 10% a year, the decline of principal could exceed the interest that you're paid. I'll touch on that and we'll get into a graph later, but that's my concern with the protection mechanism here is not perfectly protecting your principal. Let's continue with the article a little bit. All right, buffer funds, another strategy here, another name for these things, another popular strategy. Get my marker back. You'll notice I've made some notations here just to hide names. I don't mean to call it anyone's name and or any one firm or any one fund. I can't talk about funds without a tremendous amount of approval or consideration. So I have to avoid talking about specific investment products, and I'm not here to call out any analyst or any firm because I'm just really talking about the space. So buffer funds, another popular strategy, uses derivatives, claim to guard against investor losses up to a point, right, while limiting potential gains as well. And some funds even advertise 100% downside protection when certain conditions are met. Well, I don't know. I don't know how they can make that claim. A senior ETF analyst at Bloomberg Intelligence said, we like to call this stuff boomer candy, and that's what you saw in the title of the article. Boomers like being in the stock market but want the protection that helps you sleep at night. So the industry is trying to come up with funds to address this need. Having significant exposure to stocks later in life can be risky, advisors say, because if the market were to tumble, retirees needing cash might have to sell at lower prices. And so the conventional wisdom has been shifting from stocks into bonds. But many people have abandoned that approach since the financial crisis, basically because interest rates went to zero or near zero or nothing. And they have been that way until, I think, when they must have started raising rates in 2022, or maybe it was 2023, but the Federal Reserve started raising interest rates to something more palatable. So we had a 13, 14-year period where bank accounts and money market funds were paying hardly anything. And so that's why folks have abandoned the 100 minus your age, because you couldn't get any interest in bonds. So let me scroll down a little bit and make some highlights. You'll see a chart that the author provides. All right, so here we are. Boomers and other investors say they can't give up their stocks because of FOMO, fear of missing out. I mean, the S&P has logged a massive total return since March of 2009, where the Bloomberg Aggregate Bond Index has only returned 50% over the same period. So here is a comparison. Since the financial crisis, the S&P is way up here, and that's so stocks and bonds are way down here. All right, so back, I forwarded the page and made some adjustments. So there's a 61-year-old retired financial advisor in some part of the country, and he says he has 10% of his equity portfolio invested in these buffered and floored funds. Well, God bless him for putting his money where his mouth is. And for him, it's a way to get higher returns than bonds over the long term, but have less volatility than being fully exposed. I want money that I could pull from my equity holdings if something goes horribly wrong. Well, I think he's making a fair statement. I mean, it's a way to get higher returns than bonds. I think that's fair, but you still have a higher risk profile than bonds as well, with potentially more than bond yields, but the risk of loss is still so much higher with any equity investment than a bond investment. So just don't be oversold by this protection feature. And this goes on to discuss one of the pitfalls. One such fund this guy owns tracks the NASDAQ 100, and over a rolling one-year period, it aims to protect the first 10% downside in the market, meaning if the market drops 15%, the fund would be down about 5%, and investor gains are capped at roughly 20%. So in the one period this guy's talking about, the author writes about, the NASDAQ's up 37%, and you were capped at 20%. So these are some of the trade-offs that come with these funds. Even some analysts question whether the strategy works at all in rare periods of extreme market stress. I think that's fair. It's not going to work in a rare period of extreme market stress. If the market drops 50% in a year, 40% in a year, you're going to go down, your principal's going to drop by 40 or 50%, and then you're going to be paid this dividend equity premium of maybe 10%. So the market's down 50, you get paid 10, you've lost 40. I think that's going to be really disappointing to the income seeker. So if you're stretching from bonds at say 5% into this product at 8, 9, or 10%, just heads up, you're going to get hurt if the market declines. You're not going to be protected from a market decline the way bonds will. All right. So I just don't want anyone to have that confusion. Let me pause this and black out the next screen a bit. All right. Among the other drawbacks, the funds can be bought and sold at any time, but must be held for one full year outcome period to work as intended. Well, let me tell you what, it's not going to work as intended for any 1 year period from, say, June 26th of 2024 to June 26th of 2025. I don't know how the fund can make that claim. You can buy and sell options on the third Friday of every month. So potentially from the third Friday of some month to the third Friday of the same month next year, it can make that claim. But this is so hard to do en masse. I mean, if you have an annuity contract, which starts on one day and it goes for a 3, 4, 5 year period, yes, because it's contractually based upon June 26, 2024 to June 26, 2029. Like an annuity contract can make that claim, but no, I don't understand how an ETF mutual fund can make that claim. And some structured alt protection ETF, for example, is designed to match the S&P's return over 1 year with gains capped at 9.8. In exchange, investors who hold for the full outcome period are protected from capital losses entirely. I don't know how they do that outside of an annuity product. I've blocked off the fund maker because I'm not trying to call them out, but this is very hard to execute. It's just so difficult to do. No, I think this is important to know. The proliferation of these funds follows the adoption of new rules by the SEC in late 2020 that helped open to the masses a number of strategies previously reserved for Wall Street pros or wealthy investors. And not to spoil it, of course, then you have some pro that say, that's going to be quoted down here saying, oh, well, see, now you can get the same strategy that pension funds and wealthy individuals have been using for years. Now you can get it in this product. And it's a great sales pitch, but it's not a great reason for you to invest in these. Oh, let me scroll this page again. All right, here I am. So the right here, the blank, now the largest actively managed ETF in the U.S. with more than 33 billion in assets, helped popularize the category. Right, again, $30 billion, which is one of the most successful ETF debuts in history. It's got a covered call strategy that involves selling options tied to large cap stocks and generates premiums paid out in the form of high dividends, roughly 8% over the past 12 months. The fee is 0.35, so that's not too bad. There was another fund cited here with a higher expense for those chunky fees the author, for the adjective the author uses. I mean, it's going to be a price to any of these. So I don't have anyone who's adverse to paying 1% to earn 10%, right? I feel like that's a pretty fair statement, but there's no guarantees in this. So someone currently offers 8 ETFs focused on providing either downside protection or income through options. And, of course, the product's in high demand according to the maker. All right, hang tight. I might have to cut that part out, so let me get this. So here we go. The blank, now the largest actively managed ETF in the U.S. with over $30 billion, $33 billion in assets, has helped popularize the category. It was one of the most successful ETF debuts in history. It's got a covered call strategy that involves selling options tied to large cap stocks, which limits its upside but generates premiums that are paid out in the form of high dividends, roughly 8% over the 12-month period being cited. And the annual fee is 0.35. That's kind of aligned with ETFs. There's been some others with higher costs that the author's calling chunky. So another ETF maker currently offers 8 ETFs focused on providing either downside protection or income through options, and the product line's in high demand according to the maker. I mean, obviously, sure, why make it and it hopes to launch a fund soon with 100% downside protection. Again, same thing. I'd respond to the one from above in the article with 100% downside protection. Very hard outside an annuity structure. I don't know how they can how are they going to make this claim? The strategy has been around. Oh, here we go. The strategies have been around for 20 plus years, right? I mean, they have. I said it's ETF is new, but they've been in mutual funds and open-end and closed-end funds for a long, long time. And historically, they were used by institutional clients and high net worth individuals, said this gentleman from this firm. Now that they're available in the ETF wrapper, we see them used by more and more investors. Well, yeah, obviously. So let me go back to a chart here and explain kind of, how you would see this thing perform in different market cycles. Hold on, please. All right, so I've scrolled to a chart inside this article, total return since March of 2009. I guess essentially the bottoming of the market in the financial crisis. The S&P is up enormously, almost 1,000% since that time. And here bonds have been up 50%. That's approximately a 3% return for bonds. So for 3% for 15 years compound, it comes to about 50%. Now, I do think, based upon the 10-year yield today, as I record this at 4.3, 4.3 for 15 years is 188. So for the next, 15 years, if rates hold where they are, this return will be here. Clearly still nowhere close to this, but still better than it has been for the past 15 years. So I think bonds will return more for the next 15 than they have for the past 15. Can't say for the S&P, but the problem with this strategy they're touting is your investment's going to look like this. It's going to go kind of somewhat up with the market, but then it's going to be capped out because the option's being called, and you'll be paid. You'll be paid this dividend, which might put you here. Then you go again, and then you're capped out. You paid the dividend, and you're here. You're forever going to be chasing the market. You're never going to keep up with it because you're going to be called out in these products using covered calls. You just don't get all the upside, and then you get the income, which albeit gives you a little bit more return. But again, if the product's capped at 10% and the market in some year does 20, you are not going to get that additional return. So I think these will be capped out at some participation of the S&P. And then let's say the market goes down. Let me just give you a guess, right? Let's just say now here's the line and the market's going down for some period of time. Change the color again. So what's going to happen is you're going to go down with this. You're going to be paid some equity premium that'll make your returns better than the market, but you're still going down. Then you go down again, you're paid. So I think that in a down market, you won't lose as much, but I cannot guarantee you, I don't see how these products can, that potentially any decrease in the market will be offset by the dividends that these products pay. It's possible in some periods, but there's also a possibility that the declines of principal are not offset by the dividends paid. So, I'm not a huge advocate of these products. If it helps somebody who's generally been invested in bonds, if it helps someone who's been invested in bonds become invested in stocks, clearly their returns would be somewhere up here and not where bond returns have been, because stocks have done so much better. But if someone is investing in bonds to preserve principal, this product's not for them. Don't go chasing these interest rates or these suggested returns by the product maker. Hey, hang tight, I got a call. All right, well, thanks for sticking with me. So I think I pretty much said it all there before that call came in, that just make sure that you know what you're getting into with these products. You can lose more in principal than the interest pays in certain environments. More than likely, you won't keep up with the major indices by buying this, but in return for that, you'll have some greater dividend income or interest income, whatever these guys want to call it. Do have some protection in some slightly down markets, but not in the drastically down markets. So I know I'm not certain that, I don't think I'm going to call anyone and recommend these products. There's just other ways to go about generating income and not risking your principal so much. You might have to take a little less interest or dividends, but um, your principal will be a lot better protected. So I just thought I'd bring this to your attention. Things in the news that I enjoy reading these articles and about these products, and then sharing my thoughts with folks as they ask. So thanks for watching. See you back here at some point.